Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello everybody, welcome to the Wall Street Vision podcast. I hope you're having a great day. In today's episode, we're going to cover the advantages that smaller investors have over the big investors. I was reading a few Warren Buffett quotes recently, and I came across this quote where he was talking about how successful he would be if he was starting up and investing from scratch. The quote from Warren Buffett was pretty much him saying that if he was starting investing from scratch today, with a portfolio of about $1 million, he'd be able to make a 50% return on that portfolio. I think the point that Buffett was trying to make was that it's much harder to manage a huge portfolio than it is to manage a smaller portfolio. Right now, Warren Buffett manages a portfolio that's several hundred billions of dollars, and that's much harder to do than managing a smaller portfolio that's only $1 million in size. That makes sense since he has fewer potential investments available to him right now. Most companies in the world are so small that it wouldn't make any sense for Warren Buffett to invest in them, because even if they tripled in size, that just would not move the needle because Berkshire Hathaway is so huge today. So that quote got me thinking, what would Warren Buffett do if he was starting over? I like this sort of thought experiment because it can show some advantages that the smaller investors have. Now, I want to mention that this is not investment advice, and I'm not suggesting that you manage your own portfolio. This is more of a thought experiment to see what advantages smaller investors have. For my own portfolio, I have a mix of investments that I manage, and I'm also invested in some funds that are actively managed by professional portfolio managers. So I see the benefits of both approaches. Alright, let's explore some advantages for smaller investors. Let's start with a definition. What are institutional investors? These are the big investors. They're the pension funds, mutual funds, money managers, insurance companies, endowment funds, hedge funds, and so on. Institutional investors have tons of money, and a single stock purchase for them can be huge. Think in the millions or billions of dollars. These big players account for around 80% of stock ownership. They also account for most of the trading volume for stocks. So today, Warren Buffett is considered an institutional investor. Now, smaller investors are regular people that have an investment account. They might invest $50 into a stock or several $1,000s, and their total investment portfolio might be a few $1 million in size. So these are the smaller investors, and they're also called retail investors. Now that we have that out of the way, I want to tell you a story that illustrates some advantages of being a smaller investor. I'm sure that you've heard of the movie called The Big Short. The movie is based on the real-life story of Mike Berry. We've covered this story in a previous episode, but I want to focus on a specific part of the story that's really relevant to this episode. Here's a quick recap. So Mike Berry is this med school student when he really starts getting into investing. He's quite the character. I mean, here's this guy being a resident in med school during the day, while at the same time writing stock-picking ideas on his blog at night. His website starts to get well known around the investment industry to a point where professional investors are copying his trades and making money off of them. So Mike quits medicine and starts up his own investment firm. He spends a few years making stock picks, and his performance is amazing. He's absolutely crushing it. Mike's managing money for some clients at this point, and they all think that he's a rock star. So one thing worth mentioning, Mike started out as a smaller investor, but when he's managing a bunch of money for clients, he becomes an institutional investor. He's managing a big portfolio at this point worth several $1 million. Then he discovers the most lucrative investment. He finds these mortgage bonds that have a high credit rating, but in reality they're likely to go bankrupt. Mike does a ton of research. He reads the bond prospectus documents that are like 130 pages of boring legal writing. He reads over a dozen of these, cover to cover, to make sure that he's making the right investment. So he's convinced that this is a huge investment opportunity that's going to pay off. He figures out a way to bet against these bonds. It's a bit of a complicated thing, so all you really need to know is that if you buy a credit default swap, or CDS as they're called, that's a way of making a bet that the bonds will go down in value. So Mike loads up on these CDSs. He's betting that the bonds will go down in value and that this is going to make him a lot of money. Now remember, Mike's made a killing for his investors up to this point. But as soon as the investors find out that he's going for this new strategy, they get pissed off. They're angry that he's trying out this new method when picking stocks is working so well for him. The clients call and send angry letters, and this puts a lot of pressure on Mike. Now, instead of focusing on making the best investments, he also has to deal with angry clients. By the way, Mike's return at this point is a positive 242% compared to the benchmark, which was a negative 6.8%. So he's doing an amazing job, and still investors are not happy. They're not happy with him just because he changes the investment style from buying stocks to buying CDSs. His clients are upset that he's not just buying value stocks like he used to. Well, this really shows an advantage that smaller investors have. As a smaller investor, you can go ahead and invest in any asset classes that you want. And you don't have to deal with a client knocking on your door trying to pressure you to do a specific style of investing. Now back to the story, there's so much pressure on Mike from his clients that he has to fire half his small staff, and he has to get rid of billions of dollars worth of CDS bets because of clients pulling money out of his fund. The story has a somewhat happy ending for Mike because it turns out that he's right all along. Those bonds he bet against go bankrupt, and he makes boatloads of cash. He earns over $100 million personally and makes his investors more than $700 million. Even though he's right, and even though he made his clients lots of money, the whole thing was a super stressful situation that lasted several years. In the end, Mike never got any apologies from investors or any gratitude. It was just dead silence. Such a crazy story. No wonder they made it into a movie. Mike Berry has this sort of investing style where he'll buy a stock and it'll end up going up by 10x, but first it'll go down by about half of its value. One of the reasons is that he was investing in illiquid small companies that didn't have a lot of buyers or sellers. If there's no market for a stock, it means that there can be bigger price swings. So that's what tends to happen with these illiquid sorts of companies. That style of investing is hard because if a portfolio goes down by about 50%, you can bet that he's going to get a lot of angry calls from clients. Now, Mike was smart. If people invested with him, they couldn't withdraw their money out right away. They had to give a lot of notice if they wanted to take money out of the fund. This gave him flexibility because if a big client wanted their money back, Mike had time to figure out the best way to sell securities to give money back to the clients. This is something that's not always the case for institutional investors. Some of them don't have an advance notice period, so if a big client pulls money out, the institutional investor might have to sell the position pretty quickly. And if the client is really big, that could mean that the price of the security would decrease because of the rapid fire sale. That's a big advantage for a small investor. You'll never have someone knock on your door and tell you to sell your stocks. This means that smaller investors can focus on the long term. Mike Berry probably had quarterly calls with investors where he had to explain himself. Smaller investors only have to answer to themselves, and that takes away a lot of pressure and stress. That ties in with being able to have a long time horizon. When you buy an undervalued stock, a lot of times it takes over a year for the price to move up to the true value of the stock. If you're an institutional investor, that whole year you've got to answer client questions about why that stock is underperforming. Smaller investors don't have to deal with any of that. Smaller investors can also invest in industries that are questionable. Sin stocks like tobacco, marijuana, alcohol, etc. Some of those industries can have great businesses, but they might not be bought by institutional investors because of stigma surrounding their products. As an example, just think of a big university endowment fund. they're probably not going to be investing in alcohol, tobacco, or weapon stocks. Even when you think of Warren Buffett, he wants to portray a certain image as an investor to maintain a certain type of reputation. That means that there are whole industries that he's not going to invest in to maintain his image. I remember reading a book that mentioned that one reason Warren Buffett avoided short selling stocks was because he liked the image of being a buy and hold type of investor. Small investors don't need to worry about any of this stuff. Another issue is that institutional investors often have to stick to a specific investment style. Let's say you're a growth-oriented investment manager. Maybe you see an amazing cash flow generating business that is a sure winning investment, but because your fund has to follow the growth style, you can't invest in it. Smaller investors have the flexibility to look for any business, whether it's a growth stock or a value stock. Also, if you're an institutional large cap portfolio manager, you can't invest in small cap stocks, even if you think that's where the best value is. That's the issue that Mike Berry ran into. He was supposed to just buy stocks, but he saw an amazing investment in the CDSs, and his clients did not like that at all. Small investors can invest in any size company, and they have access to small companies that might not be on the radar for some of the big institutional investors. These small, illiquid companies might be great opportunities, but they would not be the type of company that a typical institutional investor would buy. Also, lots of institutional funds have sector limits. An example of a sector limit might be that the maximum percentage of tech stocks for the portfolio is 40%. Some funds can also have a limit on the percent of a portfolio that an individual stock can hold. So a fund might only be able to have a single stock be around 20% of the entire portfolio. And don't get me wrong, that's great from a risk management perspective because it gives people investing into the fund some peace of mind. It's a good safety mechanism to prevent huge positions in a single stock or a single industry. It's a good way to sort of do a double-check risk assessment for the portfolio managers. But if you look at some of the best investors, like Warren Buffett, or his mentor Benjamin Graham, or Charlie Munger, at some points in their careers, one stock was a huge percent of their portfolio. Let's look at the most recent Warren Buffett example. He bought Apple in 2016, and since then, Apple has grown to be almost half of his portfolio. He bought Apple shares for around $35 billion, and now the shares are worth over $100 billion. So imagine if he had to sell Apple stock just because it was 20% of his portfolio. He would have missed out on a lot of gains, and he would have had to pay a lot in taxes as well. That Apple investment was amazing for Berkshire Hathaway. I think that a lot of other institutional investors out there would have not been able to maintain such a huge position in just one stock. If one stock was over half of their portfolio, there would be a lot of pressure on them to trim that position. That's another place that a smaller investor has an advantage. A small investor only has to answer to themselves. So if a smaller investor made a good investment and it tripled in 4 years, they can hold on to those gains and they don't have to trim the position. Monish Pabrai has talked a lot about this. He's mentioned that he would be comfortable having a really concentrated portfolio where a single stock is a large percentage of the total portfolio weight. Now, for most institutional investors, like I mentioned before, they'd have a lot of pressure from their clients to reduce that one stock position. So that's a great thing for smaller investors. They can let their winners run, and for some of the best investors in history, they've had a handful of winners that made up a huge percentage of their returns. The last thing that I'll mention is that being a small investor allows you to enter and exit positions pretty quickly, and smaller investors can do this without moving the market. If a big institutional investor wants to sell off their total position in a certain stock, in a lot of cases that could make the price of the stock move downwards. So they have to be super strategic about how they do it. As a smaller investor, you can usually sell or buy at any time without affecting market prices. Smaller investors can also invest in tiny companies that would be too small for big institutional investors. Kind of like what Mike Berry was doing earlier in his career. So we've covered some advantages that small investors have. Before we dive into some disadvantages that they face, I'll quickly mention that if you're enjoying the podcast, please hit the subscribe button, and if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's important today as there's lots of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. Alright, back to the show. The first disadvantage for smaller investors is having less access to information. A Bloomberg terminal costs around $24,000 per year. A smaller investor is not likely to put up that much money for their research. Having said that, there are services out there that have amazing platforms for free, or much cheaper than a Bloomberg terminal, so this is changing pretty quickly. This is where institutional investors have an informational advantage. They have access to all sorts of data that can give them an edge. They can pay salaries for data scientists to use social media data, or they can pay to get satellite images to estimate cargo shipment volume. Smaller investors can't really do that type of stuff. The second disadvantage for smaller investors is that their emotions are more likely to play a role in their investing. When you're managing your own personal retirement portfolio, your skin is 100% in the game. It can be harder to make logical decisions when the consequences can stay with you for a long time. It might be harder to be level-headed if you just invested into a company and it lost 30% of its value. That's hard to stomach if those are your retirement funds. Expertise with investing is another disadvantage. Institutional investors do this as a full-time job, so they can devote their full-time focus and energy into it. If you're a small investor, you probably have a 9-to-5 job, and so you can only do research on investments in time outside of your regular work. You have to be laser-focused in order to compete with someone whose full-time job is stock picking. And even if you have great analytical ability, if you spend 20 hours researching a company, and somebody else who's a professional money manager spends 40 hours researching the same company, they will probably have an edge in terms of making the better analysis. It's not always the case, but it is pretty likely. The last disadvantage that I'll mention is that smaller investors don't have access to the same sorts of investments. One example is IPOs. Do you remember when Facebook went public back in 2012? Well, if you were a smaller investor, you didn't really have access to the IPO price for Facebook stock. All of that stock went to institutional investors because it's way easier for investment banks to sell stocks to 10 institutional investors rather than trying to sell stock to 20,000 different smaller investors. As we've covered in this episode, there are advantages and disadvantages to being a smaller investor. If your goal is to manage your own portfolio and not pay a professional to do it for you, it's important to understand where you might have advantages and where you might have a slight edge over professional investors. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thanks so much for listening, and I hope you have an amazing day. This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Before making any decisions, consult a professional. I may maintain positions in the securities discussed on this podcast. This show is copyrighted by the Wall Street Vision. Written permission must be granted before syndication or rebroadcasting.